Hello, traders. Let's talk about creating a bias. And I've got charts here, multiple time frames. I'm going to talk about how I created them and putting them together and how you could use them. Here at Master Trader, there's nothing proprietary. The education that we've created over the years, we share it openly, but there's nothing proprietary about what's on our charts. So you can utilize these in any charting platform that you're using now. And the education, of course, is universal, or the method. So how do we start? Well, the first thing to do is decide is prices. Are they going up, down, or sideways? Because if they're going up, the odds are going to be in your favor on the long side, and if they're going down on the short side. But that's a starting point. Well, how do you determine if they're going up or down? You would say, well, that's easy, Greg. I just look at it, and if it's going up, I can see it's going up. Granted, but how do you determine when it changes from going up to going sideways to going down? And one of the easiest ways to do that is to define the swings, or what we would refer to as pivots. So how do we do that? Well, we have to create or design some type of a method. So over the years, utilizing different swings, meaning how many bars are on either side of a bar that is kind of, let's just call it sticking up to make it simple, or sticking down under some bars. Well, how many bars? I've tried 1, 2, 3 fluid movements, meaning bars that move up or down with higher high, higher low bars. And it became a little bit complicated. So I came to the choice of saying, hey, you know what? Just 3 bars, however they form to the left and right, is fine with me. It works really, really well and is simple. So these red dots mark pivot highs, and each one of them has at least, if not more, 3 lower highs to the left and right. If it doesn't, it won't mark it. And you might say, well, Greg, some of those bars, let's say like that one there, that's not marked by anything. So is that important? Well, it is, because it's a large bar, what we call a range expansion bottoming tail bar. So it dipped down and came all the way back up again. But let's stick to this for the moment. So now, if it's making higher high pivots and higher low pivots, the trend is up. Simple, black and white. Now, trends happen in multiple time frames. So you can see I've got a daily chart, I've got a weekly chart, and I've got a monthly chart. Now you might say, well, Greg, I'm a day trader. I would say, well, we were going to apply the same concepts that I'm explaining here in the same way as a day trader. We're just going to use different time frames. So you got to pick a higher time frame, your longest time frame, your medium time frame, and your shorter time frame. Your shorter time frame is where you're going to act on your bias that you're creating. So when we're looking at these trends and pivots, the ideal scenario is when multiple time frames are all moving in the same direction. So in this case, the monthly time frame, say we're an investor or a swing trader, and the monthly time frame is up. Well, from an investor's point of view, we certainly want the monthly time frame pointing up. If we were a swing trader, I'd be okay with the monthly time frame being sideways, or possibly at a turning point. And that gets a little bit more involved in using the art of multiple time frames, but let's stick with simple here. At one point, this is telephone, AT&T, from 2020 into 2023, it was going down on the monthly time frame. And if we scroll back, you'd see it was going down, for the most part, on the weekly time frame. And you can see here, there were times when the trend changed, meaning this was trending down and it traded above these pivot highs. At that point, we could say, well, do I want to trade that from the long side? It's no longer in a downtrend. Well, that could be a choice, where you'd have to know how to use the daily time frame at that point in time. and the patterns that it was forming to do that. But let's just stick with simplicity for now. I say here, and as I highlight that, you can see the same point in time as that pushed up. And as it did, and the monthly was still in a downtrend, right? Your bias is that this is going to go lower. So from there, you have to move into patterns. If this is going down and this is going down, you want to find places on your daily time frame where it's aligned with that. And so if I highlight this, I have to go back further. Right? Here's where it's going down. And we find different, well, that's about as far back as I want to go. This chart. And let's just scroll that back a little bit and scrunch this up a little bit. So we're creating a bias. And so at this point, you can see here, the monthly is coming up to resistance. So the pivot high on the monthly time frame is resistance. You can see I'm highlighting it on the weekly. Now how it turns here on the monthly is very nice and organized and turn. Now you can trade this from the monthly time frame as an investor, but most of us are going to want to get a little bit tighter. Like money management would allow us to do this on the monthly time frame because we would just share size it up above here when it triggered as a sell. Now, this little head and shoulders top formed on the weekly time frame there, so you get a different picture in a lower time frame. And over here on the daily time frame, you can see that same head and shoulders top. And so how do we utilize this? So as this is coming up as it was here, the strength on the daily time frame would certainly give you pause as to thinking on the short side. But the monthly time frame, again, let's go back to it. The monthly time frame is already made the turn. So as it's coming up to this resistance area, you're there waiting, you're stalking it. Now, in this example, it'd be very nice if this formed a different pattern where it started to go sideways a little bit and gave us an entry. But I'd be cherry picking what I wanted to show you. I just picked something that here, an example of multiple time frames. So it gapped down. But as it's coming up here, you could be thinking selling a call spread. You could certainly be thinking short. You could be thinking of a bearish debit spread, different vehicles to take advantage of this, or of course, just buying puts. You could have bought out of the money puts anticipating that it was going to go down. Anticipating means it's not a fact yet. So once it breaks, as it did here, and your time frames are in alignment, we're not even talking about voids here, but this had a big void. And so you're creating a bias, your belief. And those are different ways you can act on it. So let's push this back to where it is now. And so how do we look at this and continue to simplify it? So we can do that with moving averages. So while this was pointing up, right, we could look at the 3 time frames, but another way of doing it would be to look at this time frame, the daily time frame, with these moving averages. And if the 20 is pointing up and it's above the 50, and the 50 is rising, it's telling me that this is going up on the daily and it's going up on the weekly. Now the 20 on the weekly is equivalent to the 100 on the daily. I could put a 10 on here and it would be equivalent to the 50. We don't really have to do that. You could if you wanted, but look, if these two are going up, you know the daily and the weekly are on an uptrends. The 200 is roughly equivalent to the 200 on the monthly. So you can see my cursor, how it's lining up with the 10 MA on the monthly there. Okay. So again, you could look at all 3 of these, but looking at the 1 time frame, I know that all 3 time frames are in uptrends. So if the daily is up, obviously you're going to be buying pullbacks. At the appropriate patterns, you could be buying calls. As it pulls back here, right? So here, the daily time frame broke down, which puts these out of sync, in a sense, out of alignment. However, the monthly is up, The weekly is up, and it's coming here. So now I have a belief that buyers are going to be down here. Okay, fine. That's a belief. It's not a fact. Now I need evidence of that. So what I would do is just, first of all, I would just draw this here or put a box like this as an area. I'd put a box in there. In the pre-market reviews, a lot of times you'll see, if not always, you'll see these boxes on my charts, and especially in the green room, that marks off support and red ones for resistance. So as it comes down here, I'm now watching to see if it makes a turn. What's a turn? Well, this nice big green bar, this starts moving up. So at that point, we could do a put spread if there was premium, right? Which means there's premium down below here, which higher price stocks are going to be better. They tend to have more premium. We have to make sure that they're liquid, right? That what's the spread between the bid and the ask? There's enough liquidity there. And what's the time to expiration? But we could also, as an investor, put on an initial position here, a starter position, because I don't know that it's going to go up like this. I believe it'll go up. I don't know how it's going to go up. I believe it's going to go up because these higher time frames are in uptrends and it's at support. So a starter position where I could give it some wiggle room would be fine. Or I could wait for a different pattern, maybe something like that bottoming tail bar. I imagine this was on earnings that this gapped up. You can see the earnings. The next earnings report is in April. So I imagine that gapped up on earnings. You have to be aware of when the earnings are coming out. So we could use multiple time frames. We could use moving averages to understand where they are on multiple time frames. And we have to use patterns to tell us when to act. And so these patterns, I put the little note here. Charts are pictures of others' beliefs and expectations created with money. And that's a much better way of understanding charts when you understand trends in multiple time frames, support, resistance, patterns to know when to act, because when prices come down to support, I know that there are going to be buyers down there, because those that are viewing things from a bullish point of view, multiple time frames all up, they're going to act down there. And we could apply the same thing to a currency or the S&P futures or any ETF. All of what I'm explaining now is applicable to all tradable instruments. How you utilize this information to capitalize on it through options, credit spreads, debit spreads, puts, calls, or just buying the stock or shorting the stock, all comes into play. And what we do using advisory swing and options trader, the weekly options trader, of course, in the green room. But it all starts here with this foundational information as to what's happening in multiple time frames. Are they in alignment? Are they not in alignment? Are prices at an inflection point called support or resistance? Is there a tradable void? So I hope this all helps. Assimilate it. You're welcome to come into MT Live and ask questions. We'll be doing another one this Wednesday. And of course, you can email Dan and Greg at Master Trader. All the best.